Alright guys, thank you so much for joining in. This is going to be a complete beginner's guide to personal finance. We're going to look at structuring and managing your money better. We're also going to understand debt, and there's lots more to come. So just tune in. Let's jump right in. Alright, so today we're going to understand and learn about money, how to structure wealth, understanding the monthly payments on your debt, what part goes to your principal, what part goes to your interest, and how to pay it off better. This is going to be a complete introduction to personal finance. We're also going to understand parts of corporate structuring, how to deal with the taxman, and creating a financial security blanket, which would be a runway of expenses of about 6 to 12 months. We're also going to look at some personal finance templates that are available for free. Alright, here's the disclaimer. This is not financial or legal advice. Everybody's financial situation is different. This is just a general video on personal finance and understanding money better. Before you act on anything, please do your research and consult with the right experts and do your due diligence, because there could be a lot to gain and there could be a lot to lose also. It's best that you look at your own financial situation before you make a move. A few things to keep in mind. Today we are going to look at a few compound interest calculators, also take a hard look at your investment fees, and identify certain low-cost brokers in the market that you can invest with. We're going to take advantage of the power of compound interest. You're also going to look at setting up a retirement fund regardless of your current age, and you're going to look at maxing out returns on your retirement fund. There's a very simple rule when it comes to managing your money. One, you have to earn more than you spend. The first step you have to take is to note down your expenses and income and see if anything from your expenses can be cut down or marked as unnecessary spending. So let's start by being aware of our current finances. Now, we are on the template gallery of Google Sheets. You're free to also use any other tools that you use, but we're going to use Google Sheets for today, and we're going to look at two templates. One is the monthly and the annual. Let's start off with the monthly. Now, if you scroll over to the monthly, you will see two columns. One is income and expenses. Now, ideally from your total income, you will have several deductions, and then you have your final income, which is the income you receive in your account after all deductions, taxes, and let's say anything else you want to calculate. Go ahead and put that in, right? So I would suggest that you edit this sheet and you put in the exact figures according to your income and expenses, and start to list down, starting with the most expensive. So in North America, in Europe, it's usually rent. If there are expenses, I would say that you start to list it down from the most expensive to the least expensive, and then come up with a final calculation. Now, ideally this sheet is built in a way wherein once you input certain metrics and once you edit certain things out, it will show you a final start balance, end balance, and you'll also be able to look at what's happening with your overall financial budget. Now, let's take the same thing and spread that over 12 months. Coming back to your annual budget tracker, once again you have several tabs: expenses, income, and then a final summary. So let's start with income once again. So you're seeing major numbers. So that would be the amount you receive in your account. This is what you get paid, along with any tips, bonuses, commission, or any other kind of income you've got, right? Let's total that up and come to a final number. Let's also try to include only numbers that are taken into account post your taxes, post any other deductions you may have. But if it's a monthly payment for a car or insurance, let's actually add that to your expense column so we don't miss out on that. So there are separate sections for your taxes, for the childcare, medical, any allowance or activities. Ideally, I would recommend that you pause this video, go ahead and start to do this right away. But I understand this takes planning, and also to get all your numbers in order. So I would suggest that you just keep this in mind. Go ahead and look at your financials, see if you can accrue all your data together, and then come back to this video and see how to do this. Or you can just head on over to Google Docs, Google Sheets, and find the templates, and you can go ahead and start and edit them. There are also other templates available on the internet. Due to copyright reasons, I won't be able to show you how they work. But yes, I find that this is very simple for you to follow along. Now that you have a list of your total expenses, which includes all your loans, your overall debt, and everything you spend on day-to-day life, entertainment, rent, games, hobbies, all put together, you will have one final number. We're going to take your expenses and multiply that by 6 and by 12, such that we get two numbers to understand your half yearly and annual expenses. It's important to establish that you need at least 6 months of income as savings to take care of you in case of emergencies. Yes, initially you might have to spend a lot less compared to what you earn in order to create some money left over for you to pay off your debt. But you need to understand that your expenses and your 6 month runway must be calculated on your current lifestyle in order to create more wealth for yourself. Before we go ahead, let's have a look at what we've covered until now. We are now aware of your current income and expenses. We are also aware of how to create a 6 to 12 month runway, and we understand what should be done in order to create that runway and how to manage money for the next couple of months in order to create that security blanket and pay off your debt. Now, what's up ahead is we're going to take a hard look at your loan. We're going to understand what a loan is, what your debt payments, which would be either your monthly or your annual payments, are. And we're going to look at what is a principal paydown versus what an interest paydown is. This will then help you understand whether you're actually paying out a significant portion of your loan or you're just paying interest on your loan every month and it's not contributing much towards the principal of your loan. To understand more about the basics of a loan and loan structure, principal, and the interest, we are going to look at the Corporate Finance Institute's website. So let's first understand what a loan is. Let's say an individual is planning to buy a $1 million home and he's got about $400,000 saved and needs to borrow about $600,000. Now, that $600,000 would be the loan amount that he borrows, which would be the principal. Now, the bank also charges an interest of about 5% on the $600,000, which would be extra that is paid on top of the 600,000. Now, let's take the same example that's listed on the Corporate Finance Institute website to understand how the loan is structured and how the principal pay down and the interest is structured, right? So John takes out a 10 grand loan with 10% annual interest over 10 annual payments, which means that his loan starts at $10,000. At the end of the first payment cycle, he pays about $2,000, out of which $1,000 is his principal and $1,000 is the interest. Now, what you'll notice here is that his entire loan is actually $10,000. He is paying back $2,000. Now, had he borrowed it at 0% interest, either from another source or from a friend, he paying $2,000 in about 5 cycles of payment could have cleared the loan out. This is why it's very important for you to look at the interest rate on the current loans that you've got. So coming back to the example, we see that after clearing out his principal payment of 1,000, his unpaid balance comes from 10,000 to 9,000. So what this is this is what the bank earns in a return for giving out the loan to John, right? So now let's look back at the 9,000. So once again, he has to pay back a 10%. So he pays $1,000 to the principal, and 900 to interest. So what we're seeing is that the 10% is on the uh, just the interest on the pending amount. So let's say, if we come back to the fourth cycle, we see that 700 is what he's paying because he has an unpaid balance of $7,000. But the principal pay down, he's choosing to pay more uh, every every payment cycle, or he's actually choosing to pay the same $1,000 every payment cycle. But what you can do is, in order to get rid of your debt quickly, it's always best to pay back the highest interest loans, and as soon as possible, and if possible also pay back more than the amount. So if you're only paying about $1,000 towards your principal, if you can increase that amount to a more significant number, then you can pay down your debt faster, and also the interest on your cycles will be lower because your unpaid balance would be lesser since you've already paid a lot more towards your principal. So you it goes down a long way if you're paying down that debt. So the next step would be to take a look at the current loans you've got in your life, and then you can come back to the Excel sheet that we prepared earlier. And if you take a look, you will see that certain loans are at a higher interest rate than the others. And there are also two different types of interest rates, at least in the basics. One is you'll see a fixed interest rate. So let's say if the bank says your interest rate is 10% over 10 annual payments. In this case, the 10% is fixed over 10 annual payments. Now, the bank could also come back and say that, had this been a floating uh, interest rate based loan, then the bank is allowed to change the interest rate every year. And usually the interest goes up on a loan. So it's best to pay back your principal as soon as you can. Now, the next question is, where does it get tricky, right? Sometimes your loans are packaged in a certain way where the amount of interest you're paying on that loan is extremely high in relation to your principal pay down. So what we notice in the first example is that his payments aren't the same, but his principal pay down is the same. Now, usually you might have to ask further questions to get clarity on this, but if the payments are varying every month, uh, ask the lender to give you what goes down towards the principal and what goes down towards the interest. So that's a good way to know. Now, here's another loan with the same amount, except the borrower is told that every month he has to pay about $1,627. And what you're also noticing here is towards the principal, there is, in the first payment cycle, $627, and the interest is $1,000. So in this example, you're actually paying more interest than your principal. Let's come back once again. Here we see that the total interest paid is $5,500 on a $10,000 loan. Whereas in the below example, we're seeing that there's an extra $1,274 compared to the above calculation. Not 1,200, but let's say here it is 6,274 and here it's 5,500, right? So there is a difference, and that's because of how the loan is packaged. So let's come back here and let's look at this example once again. So you've got $10,000 loan, fixed payments of 1,627 every cycle, and you're seeing that the principal pay down slowly starts to increase as you go towards the completion of the payment cycle. But what you're also seeing is that the interest you're paying, especially at the beginning, is at the highest. So what does that tell you? One, the same loan can be packaged two different ways. Some people find it easier to understand if they have their payments written down, or maybe they use an online loan calculator of some sort to figure out uh, what their principal and what their interest payment would be. Whereas some people just like to hear, okay, you've got payments of 1627. It's going to be fixed and it's going to be over the next 10 cycles. And a lot of people don't even calculate the end total because they're unaware of how much goes down for principal and how much goes down for interest. Alright guys, so coming back, this is calculator.net. All kinds of financial calculators, fitness calorie calculators, any kind of calculator will be available on this website. So let's take the same example that we took earlier. Loan amount $10,000, term, we'll keep it 10, interest rate 10, and payback is every year. Now, one thing you're noticing here is that the payment every year is 1627. Now, this is as per the same example we took priorly, right? At the end of total 10 payments, this is what you'll be paying. So this is what you're borrowing, 10 grand, and this is what you'll be paying, 16,274. But the total interest, when you click on this, you realize that there's more interest being paid versus the actual principal paid down. The lesson here is, if you can pay back more in principal, especially in the beginning, or even right now, even if you're in the middle of your payment cycle, it's best for you to go ahead and do that so you can get out of debt quickly. Now, there are different kinds of debt. One is, let's say, if you've borrowed money for your business and you've borrowed money at, let's take the same percentage once again, so let's say 10%, but thanks to the business loan, you're able to generate 10 times profit on that amount, then you actually need not pay back the loan that quickly because your debt is actually making you more money. But in this case, especially with very high interest debt, if you can pay back, let's say, beginning balance $10,000, if you can pay back maybe $3,000 here instead of actually paying back just 1,000 in interest and 627 principal, what if you went ahead and you paid back $3,000 in principal? Then your remaining balance is only 7,000, and your 10% is actually calculated on that 7,000. So it's better if you pay back your principal early in the beginning. And second lesson would be to check that from your payments to your loan, what part of the money is going to what part of the loan pay down. Is it going towards principal or interest? And you can always check with your lender to see if you'd like to structure that differently. Before we move ahead, let's just quickly summarize what we've done. So we have looked at understanding your income, expenses, and a complete breakdown of your current financial situation, which we did in the beginning of this video. We also looked at how to create and calculate your security runway, which is the amount of money that you require to cover your expenses for the next 6 to 12 months in case of emergencies, right? The next part is actually tackling the issue, understanding your current loans, what are the terms of the loan, what money is going towards the principal pay down, what's going towards interest pay down, dealing with debt and renegotiating terms with your lender, and based on the learnings that we had earlier. So now let's look at the part that's up ahead. We're just going to discuss investments, fees, and low-cost brokers. Alright, so here's what you're thinking now. One, you're thinking that, alright, I'd like to pay my debt down quickly, or you're probably in a place where you've also cleared out some of your debt and now you're looking to expand on the finances that you have. So perfect, now you're looking at options to invest, right? One major thing is that you have to understand fees, right? The first thing you should do is, when you're looking for let's say a partner or a broker to invest with, you first look for low-cost brokers, right? Just do a simple Google search, you'll find a long list of them. You might want to speak to them over the phone or look at their website to understand what kind of fees they have, right? Let's look at investor.gov website and let's understand a little bit about fees, right? One thing is that the fees may seem small, but over time they have a major impact on your investment portfolio. Now let's look at this portfolio. right? In this portfolio, there is a 4% annual return over 20 years, but the investment has an ongoing fee of about 0.25, zero point 0.5, or 1% over those years, right? So what you're actually seeing is that from investing $100,000 over 20 years, with, of course, the fees in them, you're actually seeing that 4% annual return less 1% annual fee. And then you're seeing 4% annual return, zero point 0.5 annual fee, 4% annual return, 0.25 annual fee. Now, what this means is that your $100,000 invested over 20 years is growing at a rate of 4% every year for 20 years. But in terms of fees, what you're actually losing is 0.25, 0.5, and 1%. Right? Now, let's start with the green bar, which is the 1%. Right? So at the end, you're seeing that the chart ends at 180, then you're seeing it ends at 200, and then you're seeing it ends at 210. But let's say you had a low cost broker, then you could significantly reduce the amount that you're paying and actually increase your profits, right? So it's best to look at what are the total fees, whether you're paying an annual maintenance fee, whether you pay every time you buy and you sell, and also figure out, if you invest a lot, or if you have a sizable amount that you're depositing into the account in the beginning, that there's a way to reduce some of the fees, or maybe there is, let's say the broker gives you an offer saying that the first 10 transactions are free, and just calculate how much that is worth to you. You'll also have to understand that break-even value, correct? So will you be breaking even, uh, and at what amount, or how much do you have to make to break even with the fees, and especially ongoing fees? So this is like, let's say something as simple as a debit card. They might not tell you that a debit card has an annual fee. They might say, lifetime free card, but there might be certain hidden fees to maintain the account or something or the other. So that's something that you can look into. Let's also look at the balance.com. They're also a very good resource to get information. So some of the fees is you're seeing expense ratio, internal expenses, right? So the mutual fund managers put together the entire fund, and to pay these costs, they charge an operating expense, right? This is usually expressed in terms of the total amount invested, right? Called the expense ratio. So let's say if a fund has an expense ratio of 0.9, that means for every $1,000 that you've invested, approximately $9 will go towards operating expenses. Now, this is $1,000. For every $1,000, you pay a fee of about $9 per year towards operating expenses. Now, what that actually means that you're paying it for the privilege of having to invest $1,000. That's not the only fee that you have. You might have further fees as well. Let's say fees every time you buy and sell, fees that are considered investment advisory fees, fees per transaction. This can once again be on a per trade basis or per amount basis. There might also be certain fees just for using certain brokers, like an annual maintenance fee or ongoing operating expense fee. So these are certain things that you have to look at. Certain mutual funds also charge a surrender charge every time you sell your fund. This fee usually decreases for every successive year you own the fund. So the longer you own that particular mutual fund, the less you pay in fees. So these are certain things that you have to look into. Then there's the annual account fee, but advisory fees are also something that's really important for you to look into, because uh, you're not really sure what that contains. That could be that you speak to an advisor. There's a team of advisors. Maybe it's on a per transaction basis, or maybe it's a per consultation or per visit or per call basis. So just look at low cost brokers. That's actionable one. And second, understand fees, what kind of fees that the agency is going to be charging. And third, see what kind of benefits you're getting by being a client, or by being somebody that invests with that particular broker or bank. Now, you can always look around in the market and stay updated on various offers and various services that are being offered, but it's best to have control and have the knowledge of what goes into that deal. Let's talk about financially structuring. So, we're just going to see what majority of the people do in terms of how they structure their finances, and we're also going to explore certain methods by which it's better to structure the way your money moves around in your life. So let's just jump right in. All right, we're just going to draw a few financial structures, starting from the very basics. So let's look at most people. We say a variety of people. Let's say salaried employees. What they do is when they get their paycheck, right? So they get their paycheck from, let's call this uh, an organization. They get their paycheck from this organization, and it goes straight into their personal account. Now, what happens somewhere right in between is you have this thing called deductions. Now, this includes everything from tax or any kind of cess or any extra fees or anything that can be deducted is finally deducted. Then the money is deposited from the organization into the personal account, and on the accrued income in the personal account, the individual pays a personal tax rate, right? What also happens is that because he or she might be having investments in his or her name, we're also seeing that the investment income falls under the, let's say, additional income category, and that also falls under the personal tax rate. Now, to take it a step further, uh, let's see what happens to freelancers. Freelancers could be anybody from uh, somebody who is in the consulting business, somebody who is in a real estate agent, or any kind of freelancer. What happens is, let's just type freelancer here. So you have, let's say, multiple clients. You have client A and you have client B. Let's just say, right, client B pay for their services once again to the individual's personal account. Now, at least in this case, what the individual might be able to do is he could file a corporation and have his clients pay him under the name of his corporation. So, ideal scenario, one second. All right, so ideal scenario, clients pay the corporation slash legal corporate entity. Now, I won't be able to give you advice on what kind of entity you must register. It's best to ask your accountant or your lawyers, depending on which state and where in the world you live, and decide what your needs are, and then go ahead and file. But it's best to look for a good amount of legal and financial protection, wherein your liabilities don't hit you personally. So it's good to have that kind of a protection. And what also happens when the clients pay the corporate account versus the personal account is that the individual, let's say if you're the freelancer that owns the company, uh, right, you can take advantage of the corporate tax rate. So you get all the benefits that a corporation experiences. So that's that. So compared to structure A, which is a salaried structure, a freelancer might be able to have a better structure. Now, let's take a look at what can be done further. All right. One of the biggest challenges that we've seen with uh, people that are unable to pay their taxes on time, or people that don't take into account, especially in the world of freelancers, self employed individuals, or even early stage businesses, that they don't keep enough money in reserve for taxes and other expenses and operational expenses. So let's once again take a hypothetical example. Let's say, let's call this uh, a big payment, right? Big payment comes your way, and let's segment it by a few things. So let's say, so we keep aside some parts for, let's say, operational expenses. We're also going to keep some aside for growth slash marketing. Uh, you can also choose to put a certain amount of money down for, let's say, improvement slash development. And I'm just going to leave that the way it is, okay? And you put, of course, you have to take into account taxes. If you want to go a step further, let's say you have a second, let's say you have a separate box, let's say savings. And actually, if you were to go a step further and also put in an emergency fund. Alright, so you get the point, right? So this would be emergency. I'm just going to remove this text here and move this up here. Right, so big payment comes in. In fact, if you could go back to the Excel that you had created earlier in this video and look at your current expenses and look at how much you pay in taxes and any kind of debt or loan. In fact, if you've got debt, I would say, especially if it's high interest debt, you have to have a separate box for paying off debt, right? And what you'll see is that when you have the discipline to follow a structure like this, uh, that in about a couple of years of actually doing this, you have more money left over in savings. All or most of your debt is paid off. You're on time for your taxes, so there's no extra fees that you're paying. You have a good chunk of money in your emergency account. This is for you to look at, more comfortable future. And if you also consider, if you're running a business or you're in the real estate business, and you want to acquire more leads, or anything that goes into building your network and building your outreach, or improving, let's say, the state of your business, your employees, yourself, if you put money into the right departments, you'll actually see quantum growth after a point. So that's really going to change the way you look at things. Alright, so if you were to take this a step further, what you can look at is also setting up retirement accounts, pension, or looking into government schemes from the country that you're in. Usually, if you increase the amount that you're investing into a certain domain, government does give you a tax break. So best to consult with your accountant on that. And the reason we covered that segment is so you get a better understanding of how to move your money around and manage your money better. There are also a variety of ways in which you can structure the way your payments come in, and how you invest, and how money moves around within the structure that you set. So you can either use uh, or register corporations, or you can also look at government schemes and see what kind of tax breaks are available in what segments if you do what kind of investment. So that's something you can look at. All right, guys, thank you so much. We're almost at the end of this video. The reason we covered the topics we covered today is because understanding your finances and tackling debt is very important. Let's take a look at some stats, starting with Investopedia's average income in the US. So we can see here that the median income for US households is about $63,000. And we're also seeing that the median income has gone up from 2017 onwards. So that is good news. But what we are also, what we should see as well is that in terms of debt, so this is from creditcards.com, you're seeing that the average credit card debt depends on how much you measure. So here's some numbers for you. About $1,000 plus per card that doesn't carry a balance, about 1,700 per account with a credit report and social security. The average balance on store credit cards is about 1,900. The US resident adults about 4,000 per card holder, about 5,000 per US adult with a credit card, 5,600. And average balance of credit cards at the end of 2018 is about $6,500. Now, there is segmentation by state. We're seeing that Alaska has the highest at 7,700 and above, and Iowa at 4,600. So that would be the range of credit card debt, and we're seeing that that's a majority. That's a major problem. If you also look at the percentage of households revolving credit card debt, you can see that it did dip for a while in 2014-15, but in 19 it's back again. And credit card delinquency rates also rose steadily during Great Recession and then fell off, and now they have started to tick up again. So yes, looking at debt, looking at the current challenges that you face financially, I would say if you just do a few things. One is take a hard look at your current finances, where it's going in terms of what you're spending, how your income is coming in, what kind of deductions that are there in your account. And you can also see, right, according to debt.org, there is a lot more statistics on debt. At what age are people more in debt? People based on their education and the overall debt, and debt based on their family type, right? So here are more statistics. You just have to go ahead and Google it. Uh, but I would say if you were to take action on this right now, one thing is just go ahead and look at your statements, figure out what money is coming in, how it's structured, and if there is debt that you have right now, look at what's going towards principal pay down, what's going towards the interest pay down. See if you can renegotiate that, and if you'd like to take that a step further and set yourself up in terms of also having an investment account, look for low-cost brokers or various schemes and deals that you can find on the internet. You can also look at government schemes, wherein you can invest in a certain sector or maybe with a certain fund or scheme that reduces your tax bill. So that is another thing. But yes, thank you so much for watching. It was great having you. You can leave any questions in the comments below and we'll answer them. Alright guys, thank you so much for watching the video. If you really enjoyed the 40-minute deep dive into personal finance, we have a lot more videos coming out. I request you to go ahead and hit that subscribe button and the like button because that would really support the channel. Thank you.